Hi, everyone. My name is Yulia, and I'm a part of the customer success team. Along with me, I have my colleague, Anu, who will be helping me today by keeping an eye out for your questions so I don't miss any. And just for the record, we are going to record this session and it will be made available to you after we're done. So if you need to step out or if you want to listen in again, you will have this opportunity. So I want to start with telling you how to participate in today's session. You can submit questions through the GoToWebinar portal. If you open it up, go to the question mark and then submit it there. And I will be able to see them throughout the session, and I will address those live, or we will send you a response in writing, or if we don't get to your question today, we will definitely send you an email. So the focus of our session today are scenarios with a corporation. We will talk about some options and how they differ. I will show you two scenarios. One will be very basic, and I will mostly skim through it. But then I will introduce you to our corporate planning module with more complex client scenario. We will also talk about different disposition methods available in SNAP. And finally, I will mention some considerations to keep in mind when drawing funds from a corporation. Okay, shall we start? Anu, do we have any viewer concerns so far? Is the audio okay?
Yeah, everything's looking good. Thanks, Julia. No questions yet, but if they'll come up, I'll definitely ask away. Okay, thank you.
Thank you, yes. Okay, when it comes to modeling scenarios with a corporation, we need to begin with assessing the client information you have on hand. Is the corporation material to the client's overall financial plan? Just ask yourself that. Or is it a matter of known and simple schedule of salary and dividend payments? So if the focus of the plan is on the pretty straightforward cash flow to the client, you may choose the first option, which is simply using the incomes, for example. You can even use it to model a lump sum net cash flow inflow from a future sale of a business. So you do have this available to you. But if your scenario is more complex than that, we highly encourage you to use our special corporate planning module, and I will go into details here. I must mention that for this corporate planning, it's only available under Advisor Business subscription. So if you're on Advisor Professional, you can upgrade your plan in the billing settings. But anyway, first, let's take a look at the option that is available to you at no additional cost, even an Advisor Professional plan. So let me introduce you to our first sample client, James and Jane Snapper. I want to let you know that these are made up numbers and scenarios. It's simply meant to present the functionality to you and not to, they're not real. I just want to let you know that. James and Jane are just a couple of years away from retirement, and they have personal savings, a small mortgage on their house, and a corporation. They already talked to their accountant about winding up their corporation. They came up with a simple schedule of eligible and non-eligible dividend payments, and it is what it is. They are not planning to make changes to it. They just want to see how it will add to their current financial plan. So let me show you them in Snap projections. So I already logged into my application and I have them actually here right on top, so I can simply click to view their plan. Mm. We entered their personal details. So it's James Snapper. They live in Alberta. Jane Snapper. Um, all right, so they have their base expenses, goal in retirement. Um, yeah, nothing really out of the ordinary. We have some assets here that we entered for them. Pretty straightforward. Their house is here, and their small mortgage linked to their house. But I want to focus a little bit more on the incomes. Until their retirement age, for James over here, they told us that they're receiving salary from their business. We coded this here as an employment income because it's taxable, it's RSP eligible, and we want to make sure to properly code this here. And plus, for this couple, EI and CPP premiums are being paid, and they will be receiving those benefits in retirement as well. So the type of employment is the right one here. And we want to make sure to indicate that it goes until retirement, but also through these additional two lines, we entered their dividend payment schedule. It's very simple and consistent. So for the eligible dividend, we put $20,000 here. It's indexed at general inflation. I made sure to choose the right type. Out of 4 available, this is the one. I had pre-populated for me that this is a taxable and non-RSP eligible. But I made sure to indicate the from age and to age. So this is the first 5 years of retirement. Non-eligible dividends, 50,000. Again, general inflation, the right type, and for the first 15 years. By the way, I want to highlight that this amount over here is annual dollar amount in today's dollars. Because it's a future income, it will be indexed at this rate that I put here. If I didn't want the general inflation, I could have entered my own. I could put 0 in here or something else. I can delete it and it will revert to general inflation. If you want the amounts to be prorated for partial year, for example, if they are retiring mid-year, I can choose a particular date. Now, for this particular plan, I didn't want to do that, so I'll just keep it simply as age, but you do have this option. And for that first year, this annual amount will be prorated, meaning that it will be less than a full year of this amount that they will receive. And another thing, when entering these on scenarios with a spouse, make sure to use these actions icons. You can copy the line to the spouse. And on the Jane side, just make sure to double check the amount, double check the to and from age if you're using that. But it's available to you, so you can save a little bit of time in data entry. Let's take a look on the planning pages for them on combined. So in here on the incomes, we see the income flow exactly how we entered. We have salaries for the first 2 years, and then we see dividends coming in. We have non-eligible for 15 years, and we have eligible dividends for the first 5. And I can expand this to see it for each spouse. So this is employment income for James, for Jane, and the same for the dividends. If the dividend payment is a little bit more complex than what I entered, you can simply enter these 2 income streams with a starting value of $0. And then on the individual page, you can edit them and enter whatever amount you calculated in your Excel sheet or account it provided, and it can vary. You have full control over it. And that's it really for this first scenario. I said I'm not going to focus too much on it because it's very simple and I wanted to show you that it is available for you. But I know, are there any questions we can answer before jumping to the next scenario?
Yeah, no questions here, Yulia. I think that was really good explanation.
Okay, thank you. So the main focus of our presentation is the next couple, which is Sam and Sherry Snapper. They're in their 40s. They have some savings, a house, and a mortgage. It's pretty straightforward. But they also own a small business together that accumulated some cash in their investment account. Um, it has an office, and they're thinking they're still far away from retirement, but they're thinking that they want to sell this office and invest the funds in a corporate account. And the main question for them right now is how long their corporate assets will last and if it will be enough to sustain them in retirement. So because it's so far away in the future, they still don't know what's going to happen. They ask your assistance in that. And let's see how we can help them in Snap. So I actually have them over here. Mm, let's go to scenario setup. Just for the sake of time, I have already entered their details into this base scenario. However, so there's Sam and Sherry, and you will notice that under incomes, there is nothing, completely nothing for Sam, nothing for Sherry. And that's intentional because I know that I can add all of this through the corporation. So let's start adding this information here. There are 2 ways how I can add the corporation. I mean, this button on top, it's pretty obvious, so I could click on that. But also on the list here, we have corporation section, and it's basically the same button, just colored differently. It doesn't matter which one you click. So for this corporation, let's start with, it was Snapco. The province was Ontario. And small business deduction limit, it's the same. And they haven't given me the information about RDTOH, but they gave me some information about their dividends. So their desire was to have automatic dividend threshold of $2,000. So whenever their business generates capital dividends, and if they accumulate above 2,000, it will be automatically distributed to them. So it's you can hover over these question marks to read the descriptions anytime. But All right, so let's see what's next. They didn't give me any information about grip balance, so I will ignore that for now. But the ownership, I want to make sure it's the right one. And let me double check. The ownership is 50-50 that they gave me. So let's put it there. 50-50. Now, there is also other option if they had something else to allocate. You cannot edit this, but to allocate to a third party, which is not part of the plan, who owns the corporation, you can simply reduce the ownership percentage for the spouses and it will just give it to you over here. But for me, it's 50-50, so it's good. Now, because it's so far in the future, they really have no idea how they're going to dispose of this corporation. So I'm just going to keep it post-mortem here and the method of winding up. So I'm not going to make changes. I might come back to this after we finish entry, but for now, I'll just leave everything as is. For the assets, they told me that they have investments. At this value, a reminder that this is fair market value of a capital asset as of January 1st of the first year of your plan. So we're in 2024. If you're entering, just ask your clients for statements as of January to put this one here. Okay. And I think their asset allocation was for 0 cash, 40 fixed income, and 60 equity. Okay. And they also have a real asset that they told me about. It's an office. And it's very important I enter this here because they want to sell it in the future. So let's put the future is going to be 2045. And this is not an active asset, so I'm going to put a 0, no here. And the company doesn't have any debts. I don't know anything about their insurances, so I'm going to just simply jump to the planning pages. And this one is a lot to absorb at the beginning, but once you look at it, it becomes more and more straightforward with time. So let's look at the first section, income, active income. So the couple told me that their business is making 220,000, I think. Let's double check. Yes, business income is 220,000. And that will last until the Sam's retirement age, 64. And I will also index it for inflation. Okay. So I entered this. Notice how the button turned red for me. It's prompting me to run the corporation, but I can wait. I can still edit additional details here before doing that. So they're receiving salary, 100,000 for Sam. I think until he's 64, and also indexing for inflation. And Sherry's salary is 70. And I think it's until her age 62. We will double check that, but she seems to be 2 years younger, so that will be okay. All right. And they gave me some information about expenses, 20,000 and all of them non-deductible. So I'm going to put over here non-deductible expenses, 20,000. I'm also going to index it for inflation. Now there's going to be a very interesting thing happening over here. So I'm going to run the corporation right now. Okay, so notice how this column pre-populated for me, all expenses. And I want to point out that this all expenses, it's together for both deductible and non-deductible. So it added whatever amount I have here. So when you're entering, you can, this column simply discloses just how much of that number is non-deductible. So it's just keep an eye on it when entering the information in the future. And the rest for me is being calculated, the net business income, taxable business income, etc. So I can take a look. We have two other sources of income available. We have passive and non-taxable. So in my scenario, there is none, but I want to mention here that you can use this for any other passive income for the corporation. For example, rental income. Um, you can put this here, or just any other non-taxable income. Um, after tax proceeds from real estate disposition that is not entered in this scenario, you can simply include here. Or maybe there was another corporation that was sold and proceeds came into this one. So you can use this column pretty freely, but keep in mind just to not lose track of funds. So if something comes from a personal side in the form of shareholder loan, for example, just make sure to balance it properly. I'm not going to go into details here, but we have articles available. I'm actually going to show you now. Over here, we have help and help center. And we have a whole section called corporation and business, and a lot of very, very helpful articles on different options available for you. So make sure to check it out, give it a read, and if you still need some help, you can reach us by just giving us a call, and we'll always answer. Or you can send us a message, you can send us an email over here, or you can send us an email from the app itself by starting a new message over here. And that's
Julia,
us. Yeah.
sorry, while we are there, just under the help button, can you also show where can we find the questionnaires for corporation planning? Um,
Oh,
and
you're
if like,
right.
yeah, let's look at that. Thanks.
That's amazing. Actually, that's a really, really great suggestion. So we can click on Start Here category for us. And we have um, financial planning questionnaire or the toolkit. I think toolkit will be the best because it has everything. We have financial planning questionnaires available for you to gather information from your clients. And especially the long version, it has details on corporations to help you enter them to SNAP. So we have it both in English and French. And no, thanks. That was amazing. I
Yeah.
forgot about that.
Um,
All right. Mhm.
sorry, do we have more things to discuss? I just had one more thing to point out, not under the help page, but under the planning pages.
All right.
So I know that we looked into all of these inputs and they look great onto the corporation side, but we can also see them under the combined planning page. I believe you're gonna get to that, right?
Yes, yes.
Okay,
I
awesome.
haven't
Sorry.
finished
I'm
entering
not
the
gonna jump to
information
your
yet.
script. Okay.
All right. But no, that's a good thing. Back, let's go back on track. All right. We entered the salaries so far. Mm, and let's go to dividend section. All right. So we entered the income, passive. We talked about other income. We have income tax, which is pretty straightforward. It's similar to what we have on our personal side. You can view the breakdown. It will give you the information for everything, what the tax is. So remember, anything blue is clickable. It will give you some menus, a breakdown of taxable income for you to review. But let's go to capital assets. You see that anything left over is being automatically contributed to the capital asset that we entered for the corporation. So the money is being saved. A little bit here and there, but it's being saved. And a real asset, we can see that it's the value of the real asset goes until the year before retirement when the couple told us that they're going to sell the office. And then we see the money is being going to capital assets as well for reinvestment. So we properly added that information. So let's talk a little bit more about the dividends. Now that we're in retirement, um, we need to start drawing from the corporation because the clients asked us to. Okay, so let's see. Mm, because they don't know how much they want to draw, well, let's take a look at their salaries that year. It's inflated. I mean, it's indexed for inflation. And in the year prior, Sam is receiving 150,000. So what I want to do here, I want to see if we can somehow balance our dividends to continue that um, salaries that they will receive, but coming from capital assets in the form of dividends. So let's take a look what we can do here. Mm, Okay, so we can enter, let's start with entering eligible dividends. Let's just put 20,000 just for now. Um, okay, so 20,000 and we're going to copy it to the end of the plan. I have no idea how long the assets will last, so I'm going to see what it will do to my plan. Okay, and I'm going to do the same for Sherry. I forgot to index it, so I'm going to index it as well. Okay, I'm not running the corporation yet because I want to enter non-eligible as well. Um, okay, so we can start with that. Um, and I think what's left over is going to be 130,000 approximately for Sam. And about 80,000 for Sherry. So I don't know yet if that is possible, but what I did here is that I fairly closely matched their salaries for the previous year over here through a combination of eligible and non-eligible dividends. I'm not talking taking into consideration the capital dividends. They're kind of on top of it. So we'll see. They will be just an icing on the cake. They get paid out automatically. I don't have to worry about them. So let me run the corporation and see what Snap tells me. Okay, so it replaced my values with different ones. And we can see it gradually growing with inflation, but then coming down because we're running out of assets in the capital asset. So it's just slowly going down. Um, Now I could, how many years there is going to be? 1, 2, 3, 4, 5, 6, 7, 8. So we basically can answer the client's question straight away. If the clients want to continue drawing enough funds from the corporation to replace their salaries, it will last them for the first 8 years of retirement, basically. The rest of it is just pennies. So what I can do, I can go back actually, I can go back to the scenario setup. And for the simplicity of my plan, I can simply dispose of this corporation at a particular point in the future. Now let me just quickly take a look. When I start seeing these pennies, I think I can close the corporation then. It's 2053. And I will show you how you will see it on the a personal side. So wait, bear with me for a moment. Hmm, okay. Um, so on these dispositions, just to mention it to you, I have an option for post-mortem when we're disposing of the corporation when shareholders die, or I can select a particular year. So for this one, I will just go to play it safe. It's 2052. I'm going to select the method winding up, but I also have share sales, which is not applicable to my scenario, but you have that. You can adjust this cost base and paid up capital. It's available to you. But for me, my clients here, they don't know what they're doing. So I'm going to go to the planning pages for the corporation. I will see that after the first 8 years, it's just gone. There is nothing. So let's see where the money went. On the planning pages combined, and this is where I'm coming to it anew. Let's take a look at our scenarios. Um, okay, we did a lot of this here. Um, we don't have an income section. You can see that there is no income section for our clients, but we have this corporations section. And it looks like just two columns here, total distribution and corporation value. But if I expand this, it will give me the summary, how much is drawn in the form of a salary and dividends. So until retirement, we see that there is a salary, some capital dividends, which is good. And then in retirement, in the first year of retirement, we see a non-eligible dividends coming in, and eligible dividends coming in. And over here in 2052, because I closed the corporation, its value went to zero, but there was a final distribution to the clients for in the remaining dividends. We can see more details on the individual side as well. Um, just the individual amounts over here, if we need a further breakdown of that. Um, okay, so I think we've finished with that, but I want to mention a few more things. When you're drawing from this corporation, when you're when you think that you've finished entering that, just double check a few things. Number one is take a look at the benefits. So for the clients, just keep an eye on OAS clawback. So if you want to plan on that, and if you want to reduce corporate distributions in that year, you can manually adjust them. But just scroll through this and keep an eye out on this. Also take a look at the net cash flow to make sure that all of these funds are being somehow invested in the capital assets. If you see the balances here, it means that something might not, Snap might not have the ability to invest in the client's capital assets. So just visually scan through it, double check. Also go back to scenario setup, and if your clients have RSPs, double check the contribution room. Because when we originally created this plan, um, there was no income for our clients. So Snap didn't calculate the initial contribution room for the first year of projections. And when we entered the corporation, salary is producing this contribution room, but Snap is not able to kind of retroactively calculate it for the first year. So double check that and make sure to change this. And I think for Sam, he's going to have like 18,000 for the first year of projections. So I'm going to put this here. If he was making investments, saving something to his RSP, it would have made a difference. In my scenario, he's not saving anything additionally outside of the corporation. So it doesn't really matter for me, but it's a good thing to check. Mm. And don't forget about the spouse though. Okay, um, I will mention a few more things, but this scenario is complete. And I can even take a look at the charts and show you that our inflows, sorry, let me go to the combined page. Okay, I want to show you the inflows charts because it's very good to show the client. They have for the first part of the plan, they have employment income, which is their salary coming from the corporation. And then they have eligible dividends, non-eligible dividends, and capital dividends coming in as well. When those run out, this is when they start drawing from their capital assets, like their RSPs, TFSAs, non-registered accounts. And you can easily highlight it in your client's conversations or in the report plan, in the client report. Hmm. So for this, okay, I think I'm done for now. Um, okay. And Noon, do we have any questions now about this particular scenario? I see a
No
few things.
questions, Julia, but I think like what we see onto
Mhm.
the personal side makes total sense. Sorry, I missed letting you know that it looks good. And what you've explained makes a lot of sense. So thanks for doing that.
Thank you. I just want to mention that there's a lot more to our corporate module. We have on the corporations, as I previously mentioned, you have flexibility with real assets, debts. If the corporation owns properties and different debts, you can work in here. There are insurance policies available. Um, Not something I will talk here, but I go back to our help center, read a little bit more. And we have a previously recorded webinar about corporate owned insurance. So make sure to review that as well. Um, Now, yes, all of this can be utilized for complex client scenarios. Um, all right, okay, so I already mentioned about different dispositions methods, but I want to talk a little bit more about considerations for taking money out of the corporation. Because we fairly often hear this question, can Snap tell me what is the best way to get money out of the corporation? And I can tell you that Snap can help you identify different optimal ways, but it will not implement this for you automatically. Well, at least not right now. However, there are some general guidelines that we can share with you. And one of them, first of all, just ask yourself, um, are you or is the client working with an accountant? Because accountants typically have an idea of suggested structure between the salary and dividends, and then they can share it with the financial planner. If not, then there are a few things that we can suggest. Like you can spread out income evenly. It makes sense to pull money out of the corporation evenly over a longer period of time. In my scenario here, um, I went with slightly aggressive approach. So maybe it would make more sense to not draw the full salary amounts, but maybe to reduce it a little bit so it will last longer than the first years of retirement. Um, Obviously, if pulling evenly means like 2000s per year, $2,000 per year, it's not optimal because there might be some corporate year-end costs that may be even higher than that. So just play around with numbers, and depending on the assets, other assets that the client owns, you can adjust it. Some other things to consider are, I already mentioned RSPs. If the client is receiving salary, they can grow RSP room and contribute to the RSP on the personal side. So double check that room um, for the first year, and for the remaining years, SNAP will help you with that already. If receiving a salary, there may be CPP and EI deductions, and eventually the client will receive CPP benefit. It's also something I mentioned before. If um, yeah, if the corporation is not paying dividends and only salary, they might miss out on current refundable tax and CDA balances. So just double check those. Uh, okay, what else? Tax at death. You can take a look at this. Best case might not be to pull out evenly over their lifetime, um, or to hit a zero balance in the last year. But the risk is that if the client dies earlier, there might be a larger balance in the corporation. Um, because there are many special cases for corporations, the client would be better off to leave the money in the corporation at their death. But what if it's a joint corporation? And do they have beneficiaries or trusts? So just think a little bit more on that. And you can actually, let me show you on the planning pages. For combined, oh, sorry. If we go to the side for any year of the plan, you can double check the estate before tax, and you will see the values of the corporations that year. So you can see it here, and maybe it will help you make some decisions while working on the plan. And that is for any year of the plan. Uh, okay, I think, yeah, so you can try the various scenarios and to see which is best for your client, depending on their goals, really. Um, I think that would be the end of my presentation. So, Anu, do you have any questions? Or do our viewers have any questions? Anu? Okay, I think all right, I think Anu is on mute, but that's all right. I actually do not see any questions in line. So I will add this presentation here. And thank you very much for joining me today on while talking about this very important subject. We rarely discuss corporations, but they are available to you. If you have any questions, again, go to help over here, send us a message, or give us a call, and we will help you out. Thank you, and have an amazing day.